Hello, Culture Matters podcast. I'm so excited to introduce you to our guest. But before I do that, here's a quote I picked just for this episode. It is clearly absurd to limit the term education to a person's formal schooling. Murray Rothbard. My dear friend Jonathan Fodera is back. Integrated business financing. The man of money, back again to talk about how to be successful today as it relates to money. I don't know where I'm going with this, dude. Thank you for coming back.
I love it. I want to go from there's two ways to think about this, right? Same principles, almost identical principles, to be honest with you, but slightly different moves. Okay. And since I focus mainly on business financing, we're going to stick to entrepreneurs and operators, but I'm going to start off with talking about personal success and personal finance, and then we'll elevate and go to being an entrepreneur. So what I would say is we are arguably in one of the most challenging times. If you don't feel it yet, congratulations. If you do feel it yet, welcome to the rest of the 99%. And what I would say is we are in a point of low liquidity, high inflation. And this is not to debate, it's fact. Like there's no give or take here. We saw very, very high real estate prices. We have a collapsing or about to collapse commercial real estate segment. And it's an odd time because usually, I could say, all right, buy gold, buy Bitcoin, buy this, buy that. It's not that. I'm not a financial advisor. I operate and help businesses grow. That's what I do. Right? I get them SBA loans, lines of credit, invoice, you name it, I have the program. It's more about going back to sound principles and staying in sound principles. So the first thing I would say, and this crosses borders into entrepreneurship and being an operator and as a person, your focus has to be 100% on your main income generating thing. There's nothing more important. You need to become the best at what you do. And then you need to be fiscally and financially responsible. Okay. And what I would say is this. You should be looking to invest in hard assets. And I do think real estate can go and will go down. But if the rent, if you're starting to invest in properties, if the rent covers the mortgage and then some, the rest of it somewhat falls to the wayside and is largely irrelevant at this point. And I don't want to say irrelevant, but I'm trying to find good places for you to park money, and there's not many, at least in my opinion.
Wow.
Then the next thing is the sound principles. So what are sound principles? Living off of much less than what you make. Paying down or off all existing debt that is not income producing. What do I mean by that? If I go buy a rental property and I get a mortgage, I don't care what the rate is. Okay. If I'm paying $4,000 or $5,000 a month, but I'm bringing in 8 or 9 from rent, that's a win. Okay. That's what I would be looking for in this type of scenario. You could say buy gold, buy Bitcoin, buy all that stuff. Largely, it's not a bad move, but having those sound principles are going to be the most important thing. So figure out what your fixed costs are. What are fixed costs? Rent, mortgage, car, insurance, phone, like things you need and you can't do without. You could shop them, but at the end of the day, you need them. Okay. You're not going to go without. So what I would say is figure out what your fixed costs are. And I would have them as, you know, as low as possible as a percentage of your income. And then you want to know what you're going to put in savings. So let's say you can keep your fixed costs to 30%. Okay. Your variable costs should be 20%. What are variable costs? Food costs, going out, doing whatever, just your discretionary income. And then I personally, based on where I am in this stage of my life and how old I am, I want to invest more than I want to save, right? So if you got a 30-20 on the front end of, discretionary versus fixed costs, or that's fine. But when you boil down to investing and saving, I would probably, if you're younger, let's say 50 or younger, or 45 and younger, I would be putting more and investing more. So maybe you have that 30% investing, 20% savings. Okay. And what I do myself, and this has worked really well, is I've always had a number in my head. Okay. It's not the same right now. Okay. I do not have this number. I'm going to give you the number from years ago. But years ago, if I didn't have 50,000 in a savings account, I'd go batshit crazy and work until I got that. Now, I would not change that dynamic, or I would not change that ratio. What I would do is let it build up. And when that savings account reached, let's say 75,000 or 80,000, I would take that the 30,000, okay, or maybe sometimes dip below, take 40,000 and use that for a down payment on a property, or use it for a down payment on some investment. Okay, I still think you should do that. Okay, wherever that number is that you're comfortable at, do that. When it gets to a certain point, move it over and invest it. And to calculate that number, look at like 6 months of fixed costs, right? 6 months of living expenses. And once that's covered, the rest of it should be in getting invested. And as things go down, you're going to have great opportunities to invest in certain things. Like most people, like the really wealthy people, make their money in downturns. Not, they start investing now when as things are going down, not when everything's going up or at all-time highs. Okay. If you take one thing out of this whole podcast, grab that. Okay. Guess what, guys? Your business works the same way. If you're an operator, you're an entrepreneur, business works the same way. Have 6 months fixed costs. Understand that it's going to take you X amount. Maybe it's 20,000, maybe it's 100,000 to run your business. Maybe it's $1 million a month to run your business. Have 6 months of that set aside. There are investment accounts that you could do that are very liquid to still get a return on that money. But I would do that. I would have the 6 months run rate. Okay. I would have your fixed costs dialed in. And by the way, guys, when you're looking at these ratios, always look where you can improve, where you can lower things, right? So if your business does $10 million a month and your fixed costs are 2 million, that doesn't mean try to find a way to, stay there. See if you can get that reduced on some of your fixed costs. And then the rest of it is as follows. You want investments and you want savings and you want discretionary for your company. It doesn't change. The principle works for the individual and for the business. And this is one of the hardest things, even though it seems so simple. It's very simple in theory. It's very, very hard in application. However, if you can dial this in and do this on a consistent basis, you will make it out of what's coming and what's here. And if you stick with it, you will thrive and build great wealth. And that wealth will allow you to make the impact on this world that you want to make.
What are some of those accounts that are easy to go in and out? For examples, if there's money.
Goldman has a corporate savings account or a corporate treasury.
So and what is that for the lay listener?
I don't know. I actually have an advisor myself.
Okay.
That does this for me. But I know Goldman is the source. And Goldman has a entrepreneur liquidity account or a savings account.
Hey, when you're let's go in that direction for a second here. You're interviewing for an advisor. What do you look for in a financial advisor? Like what do we not want to look for? And why should one even have one of those if they're a business owner? Right? Wouldn't they want to just do it all themselves if they're an entrepreneur?
It's a very difficult conversation for me. So this guy, my advisor was recommended by several people. When I met him, we got along, seemed knowledgeable, and he also gave to get. Okay, so he got in the door by giving and giving and giving and giving. He sent me enough referrals, and obviously I paid referral fees, but he sent me enough referrals where it covers his costs for the year and then some. So, my mind, why would I not do that? If I don't like the idea, I don't have to go with it. His background is very similar to my background, so it made sense. Like, it was a no lose. It was an offer you could not refuse unless you were so self-centered and so focused on you that you really didn't give a shit. Right. Wow. So he stepped up, proved himself, sent me enough business to cover his costs and then some. I said, fine, done. And he's had some pretty good ideas. He's done some stuff that I did. Most of the stuff that he reviewed was already set up how he would have set it up. Right. So, and he came back, to his credit, he came back and actually said that. Right. So when someone applies for financing with me and everything looks good, I'll tell them, hey, everything looks good. You know, this is what you're doing well. There's nothing I can truly pick apart. You should be able to get XYZ. Right? Where most people beat you down, make you seem like you're the problem and they have the solution. Okay. So he operated in an authentic way and that resonated with me. So I pulled the trigger with that. And by the way, if you're listening to this, it was Keith Gauss at, I probably said his last name wrong, but at Title and Financial. Good dude. Good dude. Proves himself time and time again.
In your opinion, do you think business owners are better off having the advisors in that way, in the financial sense? Having that extra voice?
Having the right advisor, I think having the right advisor matters because it's not about the business, right? It's a little bit about the business, but the wealth advisory part is about what you're doing with your profits and your income and how you can keep more of your profits and how you can continue to build wealth. The business is just a little aspect of that helps you build that wealth, right? That's the main income source that's going to help you build that wealth. However, everything else, like what you do, no one's going to teach you how to operate everything you need to know about your business. They're going to give you little bits and pieces and suggestions and advice. Okay. At the end of the day, you actually are the one that has to do it. Finance is no different. Wealth building is no different. Okay. So I do think it's important to have a second opinion from an expert in one field. What I wouldn't do is I wouldn't go to someone that is very general. Okay. I wouldn't, because I want the pro at what they do. Right. So with debt, I am the pro. If you came to me for, some type of equity for cash deal, probably not, you're not going to get the result that you want. Right. Why? Because for 15 years, I've helped businesses grow by getting them the right type of financing. I haven't done that by structuring equity deals.
If I'm going to come to you to buy a business, or I guess, am I coming to you if I'm going to buy a business?
Of course.
Why?
Because I have multiple ways to do it. And first, before you even come to me, you need to go to a broker. Okay? Because the broker is going to protect your ass in that transaction, meaning all the legalities. However, the financing piece of that, I'm either going to do an SBA or a family office deal. Or if it's a low price business, we're going to do a term loan. But the point is, I'm going to get you the financing to buy the business. You need someone that is going to be able to review the agreement, make sure the business is on the up and up, review all that. And it's not like buying a house. People don't understand that. When you're buying a business, you're looking at their tax returns, you're looking at their asset list, you're looking at their year-to-date financials, and then you're coming up with a valuation. And most times, that valuation that has been that you came up with is not actually accurate. Okay, so when I do one of these loans, I always tell people have the purchase price or a third-party appraisal. And you'd be shocked. Like I did an SBA for somebody, and they had a purchase price of 3.5 million on a business. I looked at it, I'm like, hey, I don't think this business is worth that, but I'm going to submit it. I got it through to the SBA. They said, hey, we're going to approve the guy, we'll approve the business, but there's no way we're going to do this at 3.5. They said we're going to do it 1.5 million.
Whoa.
Okay, so then, yeah, big difference. I had to go back to my client and say, hey, here's where we're at. You know, we can get you 1.5 million. You have two choices. You can speak to the seller and tell the seller his business is not worth nearly what he thinks, or you come out of pocket for $2 million. You choose, right? And this was the first time I experienced that. So he went back, got the seller to say, or fair market value. Fair market value is 1.5 million. So I actually saved that guy 2 million. Okay. And
they ended up doing it.
What was that?
The deal got done.
Yeah. Yeah. They wanted to do it.
Holy cow. What's the lesson there?
Have everything set up the right way, work with professionals.
Is the idea that if he hadn't had that even anchor, right, information from you, then and potentially maybe got an inheritance or something, didn't need to go the extra mile.
Inheritance,
overpaid for the business, and then that would affect his rate of return over time, maybe even lost money.
Absolutely. It could have been from inheritance, it could have been cash, or it could have been an equity raise.
So would you say in that scenario, that's like an example of, even though you're borrowing and you have to pay more money in the long term amortized because you got it for less money, because you had the help, the partnership, you get a way bigger return, way more leverage.
Correct.
Are these like the idiosyncrasies that people miss?
Yes. Well, think about it like this, Jay. How many people do you know have actually bought a business? Really think about that question. And while you're thinking, I can tell you that prior to being in this industry and doing that program, less than 3 people I know actually purchased a business. And all that means is think about how many people you know. So no one's actually been down that road before. Wouldn't you want someone that has traveled that path or traveled that path several times to help you and lead that? It's the same thing. And in the example I gave you, the seller was not being malicious and was not trying to screw the buyer. He legitimately thought that his business was worth 3.5, and so did the buyer. Right? But when you actually dug into the numbers, dug into the financials, dug into year to date, it wasn't there.
I'm curious, in these 10 million and under deals, do you see like an average price to earnings kind of, or valuation to earnings ratio?
No, because it differs per industry. Like every industry is valued at a different multiple.
And why is that?
That's a great question. Would depend on the industry, but like SaaS, right? Software as a service. It's more residual, obviously, right? Think about it. Every SaaS company, it's residual. So they're looking at future cash flows. There's other businesses that are just, hey, this is what it is. Also, there's certain businesses that are valued on their data. Okay, so for instance, if someone were to come in, like if Chase came in tomorrow to buy my company, that makes a lot of sense. Why? Because I have all the data from the last 4 years of clients that they want to work with. Why wouldn't you want that? Okay. There's a lot of vertical integrations there. Okay. So one, I think it depends on the buyer. Two, I think it depends on the industry.
Vertical as in supply chain.
Well, vertical as, listen, Chase does a couple things. Chase will do SBA and lines of credit. Maybe or maybe not, they'll do equipment financing. But what about for the guys that don't have great credit? What about invoice factoring? So if they bought me, one, they get all the data from all the clients that have ever worked with me, which is very substantial, or they now have outlets to my relationships where they can offer different products and programs to their clients. Why wouldn't they want those types of introductions and those types of relationships? You're buying a relationship. So that
Is the idea behind that type of acquisition that with that data, there's more opportunity for problems being solved based on whatever resources that external entity has?
I think it's
there's more. Go ahead.
No, you go.
So the value in an acquisition can be information leads to connections being made, resources being allocated, problems being solved, economy be growing. If they see 1,000 clients and all this information based on whatever frame of reference they have in resources they have, let's say they as in quote unquote a larger entity, there's more people, they're like little nodes going off the brain to potentially can get more than a smaller group of people. So that's one of the reasons that it's like larger fish eating a smaller fish.
I'll give you this
calories. Thinking calories.
Yes, that's a great example. So think about it like this. A solar company, a large solar company, would want to buy a roofing company. Why? Same exact client. Most people that are going to do solar, if they have an old roof, they're going to get the roof done. Most people that are getting a roof, it might be a good time to hit them up about solar. So there's a lot of synergy there. So when you see roll-ups, that's usually what it entails. A very large company buying a smaller company, but they have great systems, processes, and everything else. When you see the average mom and pop or the average person buying a business, that's not what you see for the most part. Sometimes you will, but buying businesses has become a buzz and is like the next, I feel like it's the next thing. And it's only because it's so talked about online and social media, right?
Is it what it's cracked up to be?
Correct. I mean, listen, it can be if you're going to operate. Listen, if I was making $150,000 a year and I wasn't happy and I had the ability to buy a company for $1 million, but I would make $300,000 a year and I'd run the show. Yeah, that makes sense, right? Those are really just based on the numbers of the business and the assets of the business. However, when you have a SaaS company or you have a company that has a lot of data like mine, and there's somebody that is in a similar or same market that buys that company is infinitely more valuable because of the synergies, right? You have all these people that borrowed money or applied to borrow money in the last, call it 4 years. Well, that's really valuable information, right? Mm. And then a company like Chase, a firm like Chase, buys that. And if they do it the right way, they market to those clients, bring them on their platform, and then they use my platform to add the other programs that they don't offer. And now you have way more revenue and it's way more valuable because most of that's going to be on their balance sheet, right? And it becomes a much larger net positive for them.
Where are ways that people muck this up?
Buying a business?
Yeah. Where can we go wrong? That beautiful tapestry painted.
There's so many different ways.
Play devil's advocate a little.
Not doing the due diligence, not having a plan after it's purchased to incorporate and maximize value. Having a terrible purchase and sale agreement, going to the wrong person for financing. Not having the money to put down, but still window shopping, like, well, you know, there's a lot of different ways that people mess that up, right? Buying a business is arguably one of the more complex transactions that you're going to do. Because even from the SBA's eyes, only the SBA's eyes, the SBA is underwriting you, it's underwriting the business, it's underwriting your personal debt, your business debt, and then your global debt. And it wants to make sure everything can cash flow, right? So when you're going through the process, this is one of those that you can't mess up, because if you get the wrong I'll give you an example. I invested in a franchise. Franchise was dog shit. Okay, the operator was dog shit, but he was highly touted. I got out of it, thank God. When I stopped doing SBA loans for them because I realized what they were about, they switched to do more predatory lending. So they went with shorter term financing, higher approvals, but they came with a shorter term and a much higher rate. And it speaks to the individual and the character of who that operator is, okay? Because I can't ethically approve something that I know these guys are going to lose money on or are going to fail. I won't do it. Like, I'd rather not do the business. And so he switched to that. And now, because these people, let's say the product worked, but it's the wrong program to purchase the product or purchase the business, you are constantly fighting an uphill battle because you could have got it way cheaper and now you're paying a higher rate. It's hurting your cash flow, it's hurting your P&L, it's hurting everything.
Because of the cost of money.
Correct.
And is the cost of money magnified when margins thin because of macro factors? Is that part of the risk?
That's always there, of course. You know, but when I'm talking about, like right now, SBA is at 11.5, okay, over 10 years for a standard working capital 7A loan. Well, if you had 10 years at 11.5% with 300,000, or let's say 500,000 to get into whatever opportunity is, well, what do the numbers look like if that 10-year term gets cut to 4 years or 5 years, and the rate increases from 11.5 to 15?
Wouldn't that? I'm sorry. Go ahead.
No, but your payment more than doubles. Okay, and now your cash flow is cut in half. The lifeblood of any business or any person is cash flow. Okay, if you have positive cash flow and increasing cash flow, you can almost do anything. If your cash flow is decreasing, it can only decrease or lower until your savings can cover it. It's just fucking math, right?
It makes me think of that natural tension between, I've been bringing this up recently and I want your thoughts on it. If let's say we're working together and we want to bring a product or service to market, and we get clear on our plan together based on the greater vision we have, and now we actually keep our word. Like we do.
I hate that you had to say actually keep.
And we'll see you next time on the Culture Matters.
No, dude, I'm telling you, like, I loathe the fact
is amazing
that you had to say actually
unpack that. Please. What comes to mind? I'll get back to what I'm saying.
Yeah. I didn't mean to interrupt you.
No, this is good. Please go down that
bothers me to no end. Your word is everything. The fact that today people just treat it flippantly people just do whatever serves them. They don't understand how much damage they're doing in the long game. Okay. I have built a company, I've built a reputation, I've built everything I own on trying to have it won. I know I have the right intent, but I also keep my word if I mess up. Okay. And it truly bothers me in this day and age that you actually have to say, actually keep their word. Like, that's a fucking shock. That's a surprise. It shouldn't be a surprise. That should be fucking standard. Okay. All the time. It should be standard. If I say something, I'm going to do it. And if it drives me nuts.
So we do it, right? The word is
Yeah.
kept.
Yes.
And it's funny because I would argue subconsciously it shows you the pressures that I'm under, and look, in the trenches in business, you see that the word is not kept for varying degrees. So,
Correct.
so we have the vision, we work together towards our word, we represent it in keeping it, and now we have an outcome. The outcome now needs to be serviced. So there's a tension between the service of the outcome and going out again, proacting, creating more. There's a tension between responding to the outcome, the results, and creating more business. So my curiosity in the economics of it, this is what came to mind. The interest rate importance, like the cash flow importance. If there is that tension between, if we have a plan and we execute on the plan, now we get the result. The result is success. Like, it's successful. We have something to service. We have clients to service. We have to service this. There's a tension between new business and service. So a higher rate, a higher cost of money can lead us to have to choose to service or get new business. Like, meaning it increases that tension. This is I want to see your thoughts on this. It can increase the tension, the anxiety, and we potentially could then, our back's up against the wall, and essentially our service can dwindle because we have more pressure to get the new business. I'm curious, like, that's why the importance of having a good advice when it comes to money.
But the new business doesn't come. Here's the deal. If you can consistently keep your word and do the right thing, it will generate way more business for you. I'm going to give you guys 2 examples or 3 examples. Okay. So first example I would give you is, I have a client that wanted me to hire me as a CFO. I'm not a fucking CFO. Okay. I told them, listen, you work with me, I'll help you and guide you. Okay. First thing I did, I got him a line of credit. Second thing I did, I got him equipment finance. His business has not substantially grown, and he's needed money to cover something unexpected expenses. The terms that I was able to get him, because he had the equipment then and the line of credit, and then I had to get him an SBA loan. After I got him those 3 things, his credit dropped, and all I could get him was working capital. Working capital is short term and it's expensive, dude. And it hurts your cash flow. Well, I had to get him 2 working capital deals. The second working capital deal, I told him not to fucking take it. Told him, this isn't going to help you. It's going to cause more stress. He says, I don't care. I need it. I said, all right, if you're going to do this, do it with me, and I'll make sure you don't get screwed. But I advise you not to take this. I told him not to take the fucking deal. Okay. Now he's calling me up and saying, hey, you were right, but his credit improved. So I'm going to try to get him an SBA to clean up the short-term stuff so he improves his cash flow. And he goes, well, what about it? What happens if the SBA declines us? Can you get me another 50 or another 100,000? I said, yeah, I can, but I'm going to give you the same advice. I don't want you to take it. I think you need to get through this. I think you need to increase your revenues and figure out what's going on with the business. The point is, money is a fucking tool. Okay, Jay, I'm sorry I'm cursing so much on the podcast, but it is what it is.
And no matter what I do, it's always ends up being explicit rating anyway. I don't know why. So it's all good. Is what I'm saying.
Cool.
We keep a PG 95% of the time, and it still says explicit on the podcast. I just don't understand.
Not tonight. You're getting me late. Okay. So long story short, I told him not to take this. Okay. And he still is moving forward, but he's not diagnosing the real problems. All right. That's one example. Another example. I'm running through the exact payments on, let's say, $500,000 with an SBA loan at current rates. SBA current rates, $500,000. You're paying just under $11,000 a month. Okay. By the time this is paid off in 10 years, you're going to pay $150,000, almost $160,000 in interest on the $500K. Cool. Not a problem. This same exact $500,000, if you did it over 5 years and you did it at the 15%, the payment goes from a $10,996 goes to almost $12,000. That is $2,000 a difference more. It's almost $24,000 a year more, and that person's going to pay almost $214,000 in interest. So at least $60,000 more over the course of the loan. My point being,
In a shorter time.
yes, my point being, oh my God, I actually messed that up. I'm sorry. I did that over 10 years. I messed this up. Give me 1 second.
No worries.
Because it was an either or question. I was off on that. And I'm off on it because I'm using bank rate calculator and it has both of them in there. So I want to do this, make sure it's all right. All right, so it is right. It did pick it up. Long story short, it's at $12,000, but that $2,000 a month makes a big difference. Okay. And you cannot operate a business when there's so much of it. When you're paying 20% more in fixed costs, that's a problem. And that's the difference between being ethical and not being ethical. Right now, how many people, that person that took the loan from the more expensive party, that person that actually used somebody else, how many people are going to have success? Almost none. Okay. Versus going to the right person that has the experience, that's doing it the right way, you're getting the optimal chances of success and to survive. And people don't realize that. And I think
that makes me think, like, is there just the culture of the lender matters. I didn't even mean to say it that way, but I forgot about the pun. Because if I'm giving money to someone that is less likely to succeed, then what's the long-term relationship? Like, we're not going to be able to lend in the future if they're done, if they're out of business. That's just me that logically. Yeah. If you're trying to have a long-term relationship. But it's part of the allure that if someone just has tons of people in their ecosystem, they don't have to actually care about the long-term relationship for them to get their piece.
To a point, that's correct. So if you can market and sell very well, yeah, that will work, and it'll work for a very long time. However, a real business, and how I built my business, is I build it with ethics, and I build it with impact and my clients in mind. So yeah, I might not be the fastest. I might not be I'm not going to win in all areas, but what I'm going to do is I'm going to make sure I get you the best I can. And because that is my code of conduct, that's my ethics, that's my mission to everybody in the company. That person that's got the SBA loan over the other company, over the other option, they're going to need more. They're going to need more money for growth in the future. They're going to be happy about referring people to me. They're going to want to do business with me again and again and again. So it increases the value of that relationship, not just between me and that party, but me and that party and anyone they're going to bring in. Versus if I gave them the more expensive deal, yeah, I probably made more money on that first deal. But guess what? I didn't get any referrals and I didn't get repeat business because they failed.
Do you think this is why it's important for a lending institution to have like a ladder of, think about this. If I have a client that starts where they can only get the base level of financing, but as they grow, they're gonna need better types of finance, like different types of financing. So I want to ladder with them, or else the incentives from the financing could be only catered to one. It's like trying to fit a square in a round peg. What's that saying, you know?
Yep. Square peg, round hole.
Square peg, round hole. If I'm going to grow relationships long term, when I'm interviewing for a lending partner, I want to see their product at ladder in a sense. Like, correct, can they even service me over like the next 20 years of growth? I'm curious what you think. That just came into my head.
No, that's a great thought process. That's how I've designed my firm. Right. So,
wow, I didn't know that.
Yeah. I have every product to fit every need, and I have the education around it. What I have done a lot in the past and what I've been successful with is giving people a plan and path forward. So I'll give you an example. I went away to the Bahamas this weekend. Before I did, I had one deal I had to make sure I got done. It was a $500,000 deal. The client had good credit, but he used his personal credit cards to finance a lot of the business, and that decreased his credit score. So I got him 500 on working capital terms. Working capital sucks. Okay, it's expensive, it's short term. But I built in certain prepays into that agreement, and I told him, you have to pay down these cards. So the plan I laid for him was, here's the money, 200,000 has to go to this. You get the other 300,000. Pay down this debt, get your credit to 700, and I'm going to get you an SBA loan for 750. That 750 will pay off the working capital. You get the discount, so you save a ton of money, and then you can move forward. I did that with one other client. Well, I've done that with a lot of clients, but I one other client recently. That client, when I spoke to him, the old client that's been through it, was very happy to provide a reference on how I've done this. Okay, because most people say they can do it, and 99% of people can't. But I laid out a path. I showed proof that I have taken others down this path, and this was a logical way to do this, and that's how I presented it. And then I let them talk and got out of the fucking way. He signed, and we were good. And all that shows you is you need to back up and follow through on your commitments and what you say, because if you do that, the business will come. Because nobody or very few people actually operate that. Most people are so concerned about the transaction or about the deal or about the money coming back to them that they don't see the big picture. The big picture is, if you do right by people, you do the best you can, and you articulate a plan, and everyone follows a plan, it should work. Now, are there guarantees that that type of plan will work? No. I have done these transactions with plenty of people that did not follow through on their end, did not go to credit repair. Like I have, one of the services I refer out a lot is credit repair. Most people in credit repair are not reputable. I found 2 reputable people, I use them, and that allows me to get my clients there after I give them the money, pay for the credit repair, get them up, and get them into better programs. Okay, I've outlined all this in detail to my clients in order to, one, maximize their growth and minimize their capital costs. All right. And it's that type of thinking. It's playing chess, not checkers. It's actually doing what you said you were going to do that allows you to grow and scale as a firm.